Hey guys, this is Julie. Thanks for coming back. So, here is the 10-year note, and I've got a daily chart showing the distributions are a 5 day, that's in yellow. So, the yellow one is yellow, the 2 and 3 are the same, blue and brown or orange, but the 20 day has the 1, 2, 3, the ones are white, the two's blue, and the three's orange, dark orange. So, when you see the 1 day or the 5 day in this instance fall below the 20 day, that's when you know that you're no longer balanced. So a lot of the times it will just stay inside the 68% of the distribution. That's that 20 day one. So when it breaks that, here we went down to the 5 or the 20 day two, and then it tested again here and held, but it did break it on the next distribution because the 1 day had fallen below the 20 day, leading you down. So when the distribution itself falls below, that will lead price lower or higher. So it went below it, and we came down to the 3, to the 20 day 3 right here, and then it bounced back up. Now, this October low has held where it originally took off outside, dipped below, went back inside, and then took off outside and went up. So now we are trying to make a second leg. So if that is your ABC, this would be the C leg and potentially at least a measured move of the AB. So you could measure this leg and say we can project that it would possibly go the same distance, and that would be looks like 7, oops. So possibly 115, 160, um, thereabouts, potentially for a measured move up and out. And so that would be favorable for rates coming down. So to keep that thesis of lower rates and that October low holding, we can look at the lower time frames. Remember, we have been going down forever because rates have been going higher. So this would be a remarkable change, right? Meaning after a long, long time of going down, we could be forming a bottom and trying to go up. So like I said, that October low is holding at the moment. And so going up, price rates would come down. So will that stick? We can look at the 1 day, 5 day. So you can see here we've had the ones inside the ones, the 1 day one inside the weekly ones, and that just shows consolidation. Here was a run up, broke that 5 day one, went to the 5 day three, and then the daily three. Here we went to the 5 day one and came back down, broke the 5 day one to the downside, went to the 5 day two, and then again back up. So here was your cross, recross, cross down, stop sweep, recross, and go. And now they're starting to buy these ones again. So this risk was held last week, right? So they're moving their risk line up. See it right there? So we could anticipate that continuation of that 1, 2, 3, right? ABC 1, 2, 3, whatever you call it. I just call them measured moves. And so we can look at it in an intraday time frame as well. And with the thesis that you want to buy low and sell high if you're going long. So the best place to buy low going long, if you like to time things, would either be at that 20-day one or the 5 hour one, sorry, on an intraday basis. Oh, that is the 5 day, sorry, 5 day one. There's the weekly one. But here is your 5 hour hedge. And what do I mean by that? I've got, let me turn the 60-minute off so you can see this. If I can find it, there it is. Oh, that's the oscillator. Here we go. Oh, I must have had two. I wonder how that happened. Okay, so here you can see that the market stays inside the 300 ones and then will break out and go try to reach your outer targets. And here it went down to the first hedge. And what do I mean by that first hedge? Well, here's your three. So your two, your 1, 2, 3 to the downside. And then if you take that distribution measuring from the mean to the three and then carry it down. Okay, so here I'm showing the mean of the 300-minute one. And if you go from the mean to the three and then carry it outside one time, so that's one time you're just half of the distribution. The other half is on the other side, right? Like the bell curve. But price goes from mean to three and out at least one time, maybe two. And two times would be the one right below it. And the two times happen to sit on that 5 day one. And that's where their risk was. They were protecting it. So if I take the 5 day one off, you can see that that's the second part of the distribution. So two times the distribution means that or hang on one second. Yeah. Means you're going from the other side of the mean to the three. You see that? So here's the mean to the three, 1/2 and 1/2 is one. And then here you're going one time fully out. So actually the first tail is only half of that distance, but it is, anyway, it's measured move. I get confused saying it, but they're equidistant, these ranges that the markets and the algos trade to. pretty much. See what I mean? Everywhere. Um, and they, when the points go outside of a range, like they break, like right here, this 300-minute one on the oscillator, the threshold. So you went up and you were, at 20 points um, for the range, all the way up to 40 points for that period of time, which was measuring a 5-minute period of time. And if you measure that bar, you will see that it's 40 points. So, but the 40 points ended at the 300-minute 2, which is 68% of that 300-minute range. So your sell-off was stopped cold by the algo wall, saying you've reached 68% of that 300-minute range. And then the algo wall was in force, and they deflated the range, and you see the volatility got real small going down from right here to here. Well, it was also the end of the day. But then the next day it picked back up at this lower 300-minute one. And you can see here the 5-minute range stays below that daily range 1, 60-minute range 1, sorry. So the 5-minute range stays below that 60-minute one, and you're inside this 300-minute one also. See the 300-minute ones up here. So anytime you're below the 300-minute one, like most of the time, you're just in low bar volatility. When you break above that 300-minute one, you're going to see the bars increase in size, and we can look to see the target to trade to, either on these, time frames, or using the higher weekly, 20-day, 1-day, 5-day ranges. But I also, this here is the, look at it before I tell you. It's like daily 1. Okay, yep. So you got to the daily 1 range here, and so that progression came to a standstill right there, and you can see that when they brought it back under the range and started going back down, that is your fade. You see that? So it was, let me change this so that you can see it. You can't see it because it's a line and not a square. Let me make it a square, and you can see it. You'll see that it turned around and went back down. So that's very typical of how the volatility traders trade. They will get to a level, drive it to that level, and then turn it around. So it was going up, and then it started coming back down inside, and then all the way back to the distribution inside the mothership. And then you can see all of it flattened out. So even though the price went to the hedge caught it, and the lower volatility confirmed the fade. So you wouldn't be looking for a further downside break unless you were back up and going long above that daily 3. So you can tell from the position of the realized range, the realized volatility, compared to the historical volatility ranges, what to expect. So we can expect price behaving below that 300-minute one, and when it gets above that, that's when we can expect that range expansion and then a range collapse back inside the small range. See that? It's real tiny. You can't break out on a small range. You have to have that going back up. All right, so again, we retested that October low, and I also have a 60-minute hedge. Let me put it back on. That works a lot of the time to position yourself if you're looking for a nice, sweet area to consider. Like if you had a long thesis that it might be turning around, you might look for those lower levels to get reached and then see if they turn it around or collapse the volatility, allowing that price to continue going higher. Um, and, buy low, sell high. I mean, sorry, I'm fumbling here. Spread this out just a second. All right. So, what are the examples of the buy the dip? Obviously, this 300 hedge if you're long, or let me see it intraday. You see here how we got the one to cross the three, or the excuse me, the 1 hour to cross the 5 hour here, and it went to the 5 hour three. And for low dip, see it bought the 300 and 60-minute one here at 9 a.m. So this 60-minute um, lower one and the lower 300-minute one. And that was a reversal. So this was your big breakout, and that was a test of it. And now we're going back up, or trying to. I hope that's not just flat consolidation and that we do have a chance to go higher next week with ZN and bring rates down a little bit. That would be so awesome. Um, but just keep your eye on these ranges like this, and that would tell you what your chances are of continuing that. Whenever you're above the 5-day 20 like this, you don't want to be looking short unless these levels break lower. So if we do pop down to test this 20-day one right there, 5-day one, 109, 285, I'd want that to hold if I had a long thesis. And likewise, this 1-day, 5-day. Anytime that we are above that lower one um, is good, or the prior higher one. There is a little bit of gap there, so they could come back to test that and then take it back up. All right, I know all their tricks. All right, sweethearts, we'll talk to you later. Thank you.